Hey everyone, my name's Andy. I'm from the Finding Value Finance channel. I'll be your host today. Today we've got Kasper, Uselink from Twitter, and we've got Scott Win Moon from Sill and Reap Capital. So we're all in different time frames, different parts of the world. Kind of tough to schedule since I'm early, Uselink's in the middle of the day, and Scott's late. So, well, let's start it off. I'll start with Kasper first. Which sector do you think's the best right now in terms of whatever you want to measure it by? Charting, fundamentals, doesn't matter. Valuations, ratios, however you want to do it. What sector do you like the best, and how are you playing it?
Yeah, I think it's no surprise that I still think that the best value right now is uranium. Even though the past year we have gone, sideways to down in most of the miners, I still think, the fundamentals that we get each week is it gets better. Gets better and better. And I mean, I entered in late 2020, and ever since then, the news flow for uranium has just been crazy, more or less, how to say it. And also, I think we last time we spoke, Andy, we also showed some ratios. And still, you're looking at the miners compared to metals or compared to almost anything. It's more or less the most undervalued sector, in my opinion. And I think in maybe in like 1 year to 5 years, when people are looking back, those who were not in this sector, I think they will be scratching their heads and saying, how did I miss that one? So yeah, there are fortunes to be made here in uranium for sure, no doubt.
So, so you're obviously in the uranium camp. I see Scott laughing down there. what what sector do you like best right now, Scott, and how are you playing it?
Kasper, I'm glad that you said uranium because otherwise we could have gotten into a bit of an argument. But yes, of course, uranium. Of course.
Exactly, of course, yeah.
I've never seen the fundamentals so great for a commodity. Never,
No,
ever.
I agree. I agree.
Like supply and demand picture. I did a video on my YouTube channel just today, and we were talking about a supply deficit that is probably greater than 100% of annual supply. Like, I mean, it's insane. And I feel like everyone's rushing towards it. I think as soon as the money flows into the sector and we get a bit of momentum, I think retail is going to massively chase it. And so I think this could be the next crypto type of, investment or speculation. So I think this is the greatest by far.
I agree.
Yeah, no, I'll give my opinion. I'm more. I guess I'm the minority
Don't
here.
disagree, Andy. Don't disagree. Uranium is simply the best. Don't disagree.
I don't disagree with what you guys are saying, but I guess I can't get away. I can't shake my oil and natural gas blood. So I just think the setup is so good. So the valuation is definitely goes to uranium. I don't debate that. You guys are definitely right there. And that's why I have exposure to uranium. But I think from the lines of a probability standpoint, I'm going to go with the probability standpoint. I like oil and natural gas because I think the cash flows of oil companies are massive. I think they are undervalued in relationship to the current price of oil and natural gas. And I also think that oil and natural gas in relationship to other portions in the world, so think Henry Hub versus overseas, it's underpriced. If you look at oil and what they've done with the Strategic Petroleum Reserve and kind of hold this thing down, it's just a matter of time before it goes back up. So if you look at it, if they're actively holding the demand down and releasing supply at the same time, holding demand from China, they're doing their COVID zero policy, they're holding it all down, and then we've got the Strategic Petroleum Reserve releases. We've got very high natural gas prices over in Europe and in China. And I can buy companies that are, 50, 60, 70% underpriced to the current oil price. It's like, here's a couple of, some free money, just go pick it up. And so then I take the probability. So I overweight the probability. I think you guys are maybe I'm misstating this, swinging for the fence because it's so cheap, and I understand that. So those are, I think that's the large difference between maybe us. What do you think about those differences that I just stated there? Valid, invalid? Don't worry about it. Swing for the fence. Kasper, what do you think?
No, I agree, but the uranium gas and oil all has that in common, that it is energy related, right? So I think whenever, and I agree, oil will go back up again once China opens up and the US stops this SPR release, and I think that will drag the entire energy complex with it. But I think when everyone was very bullish on gas like 2 months ago, I also mentioned on Twitter that I thought it was a crowded trade. And correctly so, it pulled back like, I don't know, 30% or 40 maybe even. But I agree with the gas as well. It's not over, and I think we will see a major leg up somewhat soon. But that will be at the cost of many people's way of life, I would say, because as you mentioned, here in Denmark, the gas has went up like 500% or so. And I know people that are struggling more than we are. I mean, me and my wife have a somewhat decent job. We're both engineers, so we can manage. But there is a lot of people who doesn't have that extra capacity in their bank role, let's say. So yeah, it's not going to be good for most people. But I agree, gas will also go higher at some point. Yeah.
Yeah, and I know it's expensive for you guys. I'm talking about Henry Hub in America. We haven't really moved up yet. We're at $5
exactly.
a million cubic foot. You guys are like at 20, 30, 40, 50, depending on where you're at. So
yeah,
I think that'll converge when the LNG terminal goes back open. So that's what I'm playing, is the arbitrage between the two areas. Scott, what's your take? You're still a uranium bull over the oil and natural gas, even though you can buy this stuff cheap?
I am.
Yeah, same.
I'm sticking with my uranium.
All right.
So here's the thing. So I 100% agree with you that oil and gas would be a no-brainer absent uranium for me. So if there was no such thing as uranium and nuclear power, that would absolutely be the thing that I've been right now. And I think the companies that you show me are very much undervalued. So in terms of their cash flow, operating cash flow compared to their earnings, compared to their revenue, compared to their potential, if oil and gas prices were to go up, I think they have a huge potential. But I just think the potential is a lot greater in uranium. And I don't necessarily think there's a greater risk that carries with uranium. And what I mean by that is there are a couple of risk factors that we need to consider. So if we think about a bear case for uranium, obviously there's the deflationary pressure, which will affect everything, right? So it will affect oil prices, it will affect gas prices, it will affect uranium prices potentially, and it will drag everything down with it. So that's equal across the board. But with uranium, I think the only other bear case is really the a nuclear accident. And so I don't think it's very likely. I think it's very unlikely that there will be a nuclear accident that destroys this bull run. If we look at oil and gas, what kind of worries me a little bit, and no doubt I'm an oil and natural gas bull as well, right? So I have I would definitely be on the side that natural gas and oil prices are going far, far higher this cycle. But if I think about oil and natural gas, the risk from a probability perspective could be greater than uranium, in the sense that if there is a resolution between Russia and Ukraine, and for some reason that everything is like kumbaya and let's hold hands together back again, right? that could bring down natural gas prices and oil prices. And the reason for that is because Russia produces as much oil. I think it produces like 10% or actually 16% of world's oil. It's a huge figure. They are right there up with Saudi Arabia, for example, in terms of oil production. They are right up there in terms of gas production, and they have the biggest natural gas reserve in the world. So for me, the likelihood of the risk that, well, it's a risk from an investment point of view. Obviously, from a humanity point of view, obviously it's a good thing. But from an investment perspective, the likelihood of the Russia-Ukraine conflict de-escalating versus the likelihood of uranium, nuclear accident derailing the uranium bull story, I think is a little bit greater. So that's why I think actually if you're thinking about the risk rewards, actually I think I favor uranium over natural gas and oil from that perspective. So that's another way to look at it. But 100%, if it was just a normal investment, and if we're just talking about a cash flow company versus a non-cash flow companies, then obviously I 100% agree with you. But there are other factors that I think we need to consider when we talk about natural gas, oil, and uranium. So that's my perspective. And in terms of the potential gains that come with uranium, obviously it's a no-brainer if you look at the past cycles that it will. Sorry, I'm making it sound like it will definitely happen, but it's very likely that it will outperform everything else. That's just my opinion.
Yeah. So my take, I'll kind of be the oil natural gas bull, I guess. With uranium, and the reason that I'm hesitant with uranium is because I don't know the timing of it. I don't know the inventory levels. I don't think anyone knows the inventory levels, and that's where I think that the potential's there, but we don't know when. So I'm not as convinced, or I'm not as sold on the when portion than I am. I'm sold on the returns. Don't get me wrong there. It's also very speculative by nature. But if someone said, "Hey, look, with an hour just to paint a picture, China's on lockdown. We've got the United States releasing the largest strategic petroleum reserve release in its history, draining inventories worldwide at the fastest pace ever. And China's on lockdown. What would the price of oil be in your guess if you didn't know what it was? Would you say $40, $50, $60? But we're up here around, mid 80s, low to mid 80s. And if they open up, China opens back up, and you can buy these assets undervalued already. We know the inventory levels. We know all of this stuff. Why wouldn't you take that bet? Why wouldn't you take the money that is known versus the potential? Or do you guys think that it is imminent, that uranium will go up, it has to go up, and you think it's going to happen at any second? Is that what you guys are thinking? You can go, Kasper, if you want first.
Yeah, yes, I do think that, given the fundamentals that we've seen, especially in China, right? They're building like 10 nuclear reactors per year for the next 15 years or so. That's 150. So the amount of demand that is coming online, that is coming within the next 10 years or so, it's just so much above what we currently produce. And especially in the States, I think you produce like almost zero, right? So so I think there will be, well, nothing is certain, but it's very likely that there will be a very big crunch at some point in time. If it's tomorrow, probably not. But as I have mentioned many times, I will be a uranium bull until we reach triple-digit uranium. And I think we'll go far into the hundreds, yes, but until then, I will not do anything regarding adding whenever we have a pullback or anything like that. So I cannot see a way or why we shouldn't have higher prices right now, because we have seen natural gas go up like 1,000% in Europe, and oil as well, coming from like 0 to 100 and what was it, 30 or so. And I think uranium has barely moved, right, from like 18, 20 to like 50, 60. So I think there's still much more to come. But I do think as well, back in 2020 and 21, the miners got a bit of ahead of themselves with regarding to valuation. So I think the pullback we have seen for the past year is totally standard, and we will see that one more time or two times in this bull run as well. So yeah, I do think we will see a lot higher prices for uranium, definitely.
What about you, Scott? What do you got?
Yes, with uranium, I think things are becoming a lot more imminent. So you've got major catalysts coming in Q4, Q4 this year and Q1 next year, and that is really the ANU. So ANU fund is planning to raise $500 million US and buy up a bunch of uranium above ground. So that's going to dry up the available uranium above ground. And we've also got Kazatomprom contracting with China right now. So that's going to drain, well, supply for the rest of the world quite dramatically. We've got major producers who actually have contractual obligations that are buying up uranium above ground because they're not producing enough, like CGM Mining, for example. So they are buying up. So we've got all these factors lined up. I feel like a Japanese, obviously, we've talked about people talk about how Japan has ample supply of uranium, yet they're going to Kazatomprom to try and source more uranium. So I don't think they've got any. Well, they've got okay, not to say that they haven't got any, but they are looking to buy more rather than sell into the market. So I think all these things are lining up. And if you look at the past history, just in terms of charting as well, and where we're in the bull cycle, we don't typically see a long drained consolidation period. So this is quite long compared to the 2000s run, for example. And so I think, yeah, it's about time. We've built up plenty of energy, just going sideways for about a year now in most of the developer names. I mean, CCJs continue to make higher lows and higher highs, which is great to see. And we are about to see a cycle high again, this cycle high again in CCJ, Chemical Corporation, which tells me that the institutional money and the big money is really continuing to position themselves in uranium. And that those signs like Peloton Energy, for example, that's continuing to show strength. It's nearly at its all-time, this cycle high. So all these big names performing really well tells me that the institutional money is really positioning themselves, and they're going to push into some of these smaller caps soon, as well as the spot price of uranium. So U.UM, for example. So I think stars are definitely lining up. We've got seasonality coming up. We've got the contracting cycle coming up as well. And so I think stars are all beautifully aligned for uranium. And really, granted that I think oil is going to, short term, oil might be a surer bet because obviously SPR release is coming to an end. I think that's going to be huge. And potentially I think there have been talks around them replenishing the SPR that they've depleted in the last couple of months. It's like, what are you doing? So you know, if they decide to do that, that's going to put a lot of fuel on the fire for oil. But I mean, I think energy in general, everything energy related is looking stunning, to be honest. So you can't really go wrong, I don't think.
Yeah, the thing that I'm going to say, I think Russia's going to lose a couple million barrels because of the sanctions. Western companies came in, they were basically pumping it. They all moved out. Winter time's coming. It's going to drop a couple million barrels. The Strategic Petroleum is going to stop putting barrels in, 1.5 million barrels a day. That comes offline. China comes online with a positive 2 million barrels. I can see, I've got line of sight to that. I don't have line of sight of uranium. So that's my only thing against uranium is I don't have line of sight to the inventory level and I don't know where it's at. So that's what gets me a little bit, wishy-washy in the short term. And if someone says, hey, look, here's going to be a setup where oil could double or triple in 6 months, I'm going to take it. That's just me. And your companies are discounted 50% or 30% of the cash flow of today, which means that if you get a double in oil price and you're 30%, so you're 3 times 2, you're going to get a 6-bagger, which is, I think, a high probability. Then I can go roll it into your junior uranium companies and turn that into another 10 or 20 bagger on top of the 6X. So fingers crossed, hopefully that's how it works out. I don't know if it's going to work out that way, but I still own a lot of uranium. That's the only thing we can end it there. Now, here's another thing. So getting the sector right is one of the biggest things as an investor, is identifying where the value's at, getting the right sector. Now, the second portion of this is how do you play the sector? What is your strategy? What's your approach to playing uranium? Because I know you guys are big uranium guys, so I can ask, uranium. Do you invest in the producers? Do you invest in the kind of the developers? Do you invest in the exploration companies? How do you play this? If you're a new investor, do you just buy an ETF? What type play would you be doing? And I'll give you my opinion after you guys, but Kasper, what kind, how are you playing this, and why are you playing it the way you're playing it? Is it max leverage? Is it the probability of success? You know, maybe perhaps answer that way.
Yeah, just to start with, I think you said that one of the hardest things is to get the sector right, but I think also one of the hardest things to do is to sit on your hands when you know that you have conviction in the trade or in the fundamentals. You have to just sit on your hands. And it hasn't been fun, for the past 1 year, let's say, for uranium. It pulled back like 40%. But if you go back to the previous cycle, during the entire bull run, you actually had like 5 or 6 times when it pulled back 40%. So I kind of knew that it was coming. So for that, I had a plan, whenever I see this 30-40% drop, I will start to buy again into what I already have or something new. And regarding to companies, I have a mix of all. I have the big ones like Cameco, Energy Fuels and so on. And then I have some mid-tier, but I also have some very, very high speculative plays. But that's a very tiny fraction because, it's very high risk. But if the risk gets in my favor, it will easily be, like a 50 bagger or so. But I could just as well lose it all within a day. So I have a mix of all. But yeah, that's how I play it. And I don't try to sell the market or to sell into strength. Maybe I could do that, I think. But then again, I have made a plan 2 years ago, and I'm sticking to that one. So whenever I see a pullback, I buy until we get to those ratios or those to a spot price that I have determined, right? That when we get to that area where, let's say, spot price is 100 or 200, whatever it might be, then I will start to sell out. But I have a plan, and I will stick to it. And I think that is the most difficult part. But that's also where you learn a lot about yourself, actually, from a personal point of view.
So when you look at allocation, you said you own all of it. What kind of percentages did you put towards producers, developers, and explorers? Like, how would you break that out? And it just has to be rough estimates; it doesn't have to be perfect.
I think it will be like I have like 10% in explorers, maybe 15. And then I think 30% in the majors, and then like 50, whatever it is left in the mid-tier, the developers and so on. So in that area, I would say. I own a lot of Denison and Energy Fuels, UEC. They are producers, I know, but GoVX, I have a lot of Fission, NextGen. Yeah, all the bigger known names I have, and then some smaller ones like Atomic. It's a very, very small company. I don't think anyone has heard of it, but it's like a $4 million market cap. So it's a tiny one. But I only have, like a few grand in that one. So if that goes bust, okay, it is what it is, right? But if it goes 50x, it's not so bad. So that's how I play it. So
and your portfolio allocation, I know that you don't just own uranium. How much allocation do you have to uranium versus some of the other sectors?
I think in total, if you take my entire portfolio, I think I have 40-50%. More like 50% in uranium. Then I have, of course, gold and silver, platinum, shipping, palladium, copper, and so on. But 50% is uranium, and that's because I'm in the same boat as Scott. I think uranium will be the best way to invest for this decade. And I've said that 2 years ago, and I would say that again, in like 1 year, maybe. So I put my money where I think the best return is, and hopefully it works out that way. Hopefully.
What about you, Scott? What's your portfolio allocation if you were to break it up, and how are you positioned for this?
So yeah, I've got pretty much equal amounts across producers, developers, and explorers. So 1/3 each, I think, of the uranium portfolio. So when I first started investing in uranium, I think it was largely just the producers. So Paladin by far was my largest, and then I've had a couple of developers, near-term producers like Boss Energy, for example. But then during the last run up, I did sell out of some of them. So in that sense, I was kind of trading, which I'm not planning to do much anymore. But I am now positioned in over the last couple of months, because I've seen some ridiculous prices in the explorers. I couldn't help myself but get into more of the explorers, which is why it's blown out to 1/3 of my position size now, because I just saw these ridiculous prices. I was like, yep, gotta get in. So that's why explorer positions are very high right now, higher than what I would typically go for. But I just feel like the risk reward setups for these explorers are fantastic, because they are pretty much trading at, I don't know, like really low EV, enterprise value. So for some of them, like you're paying nothing for these sites. So I feel like you're getting a lot of value for the explorers. I think next leg up, I think explorers will do extremely well. Obviously, a lot of the explorers have been laggards so far in that they haven't really gone up too much. So, you know, one of the best performing stocks so far is, you know, a big producer like Paladin Energy, right? But I think the next leg up, and during the middle of the next leg up, I think explorers will just hugely outperform. And I think they will do very well, which is why I think I might even think about selling some producers along the way to get into more speculative explorers if they don't go up in price, or as much in price. But that's kind of how I'm positioned, quite equally across producers, developers, and explorers.
Yeah, so in my setup, I'll explain what I've done to some degree. I'm much less exposed to uranium, I guess, in a percentage terms versus you guys. It sounds like you guys are over 50% of your portfolio or whatnot. I'm much more heavily focused on physical precious metals and the swapping ratios. So I've got a much larger allocation to that than I think you guys do. I'm probably for uranium, maybe 15 or 20% is probably what I am exposed to. I put a lot in oil and natural gas in the beginning. I view oil as the master commodity. I think that oil is something that has to go higher in an inflationary period, because when you have money coming into the system, it has to translate through energy and oil being the number one commodity. I see it as a probability bet. So my portfolio is structured around risk reward and probabilities. And I think uranium is a great investment. That's why it's such a large percentage of my portfolio as well. But the thing that I get a little bit nervous on is a lot of these companies are very speculative, and the cash is what gets me, the cash flows or the lack thereof in uranium. So I'm just like, oh God, I wish there was equivalent oil companies. You know, like in oil, these guys have infrastructure in place. They've got production going. They can ramp production. I look at uranium, I'm like, I don't see any infrastructure in place. I don't see the ramp. So I get a little bit more afraid just because there's not as much cash flow and I can't allocate as much to it because of that reason. So I've always taken the risk and probability bet, where if a company is, and this is why I think it's played out well for me, and maybe it'll play just out ridiculous for you guys in the uranium sector too, and hopefully it does, because it would benefit myself. But the way that I viewed it when I first went into these trades was the infrastructure's in place, the production, they can produce. Now it's just a play on the commodity, and it's a highly leveraged play to the commodity. And since they had large amounts of debt, they got sold off to pennies on the dollar. So the value was there. It just needed to be realized through the price of the commodity. In uranium, I think it's a little bit different. The setup's different. You're playing more of a speculative play, and the value may or may not be there because it's going to be reliant on a third party buying it from you, or they have to develop the value through the infrastructure that they develop, if you're playing it from the Lassonde curve of a developer and trying to get that to develop. But there's a lot more risk in doing that than a company that's already got it in place, that's been decimated just by the commodity price. And they're in the number one commodity, and you've got visibility in the inventories, and you know that the world is really tight in terms of supply, demand, and balances. So, and I obviously that we know that in uranium too. So the difference here, and I think the difference between, I don't know, us is I just look at the probability, and maybe you guys look at it differently. Maybe you're thinking the probability of uranium is going to be a lot higher than oil, and the risk rewards better. But the risk, I think we view the risks maybe perhaps differently. I view risk as a speculative play with a company that doesn't have cash flows is a higher risk, and oil and natural gas specifically, I've got cash flows in companies that are ridiculously priced in relationship to those cash flows, and a commodity that looks like it's ready to launch. So, you know, how do you guys view risk, and how are you handling that risk? And in terms of uranium, how do you view the risk in uranium? You can go first, Kasper, if you've got an answer, or we can go back and forth.
Yeah, I think it's a somewhat short answer from me, but I think, as Scott mentioned, I think the only big risk for me in uranium is, you know, if you get a nuclear accident. I can't see anything else, you know, getting in the way of this massive movement that we see for the past 2 years or past 5 years, let's say. So I do think the risk is somewhat low in uranium from an investment point of view, but to be said, I think also it would be a lot more explosive, you know, as we've seen in the past cycle. When things gets going, you know, it's a very tiny sector. I think what is the market cap, like 40 billion, so 50 maybe. So even if you want to have big companies going in, they can't even put money into it. So I think it's a lot more explosive, but I think even though it is very explosive, it's I only see one risk, as mentioned, and that's a nuclear accident, more or less. Because otherwise, together with oil and gas and coal and so on, I think we are in a major energy crisis. So I cannot see why, you know, this nuclear not going high from here would just be a big surprise for me, at least. I could be wrong, of course, but that would surprise me heavily if that doesn't go higher from this stage. So
here's a thing that I'll kind of ask a question. What about the risk of dilution, or the risk of
sure
of a company that wants to actually try to build a mine, and they need to raise money, and in an increasing interest rate environment, maybe that cost to raise money becomes a lot more expensive because of higher interest rates. So we've got dilution, the way that I view it, dilution risk. You've got the cost of capital that's increasing. You've got the supply chain shortages that can also impact a company that wants to develop a mine. You've got cost overruns. I've seen that the cost curves have been going on up for Paladin as they try to open up. So I'm looking at this and I'm just thinking, well, if these companies don't have all their stuff in place already, there's a lot of risk there of them raising capital. Would you agree or disagree?
Oh yeah, absolutely. I mean, if you have a company that doesn't have any cash flow, and they can easily dilute, you know, the stock by 30% from one day to the other, no doubt about that. But I also think, you know, Paladin back in the last run, I don't think they weren't even producing at that time, or were they just had pounds in the ground, I think, and it still, you know, went up.
They went into production.
Oh, they went into production. Okay, fair enough.
Yep.
Right towards the end of the cycle.
At the end?
At the end.
Yeah.
Okay.
Right towards the end of the cycle.
Yeah. Okay. So I think. Sometimes, you know, no cash flow is it's not a bad thing, but I think in this case, you know, when and if, you know, the commodity goes from, like, which I think it will, from 50 to 100 or 200, the run up from that point will be so short that I don't see that as a big enough risk not to be somewhat heavily invested into it. Because I think, yes, maybe one stock will dilute 50%, but then I have 10 others that hopefully in that period will not. So yeah. And that's also why I think you should have the bigger ones as well, you know, Cameco and those kind of places, because they can produce. And that's also where you have to have your main focus, in my view, is on the big ones, and maybe the mid tier, and then a small allocation to the small ones, which could blow up from one day to the other, more or less. So yeah.
What about you, Scott? What's your opinion on the risks here, and what makes you so confident to just kind of pile into uranium as much as you have?
So I don't have over 50% of my portfolio in uranium. It's like 40%, I think. Maybe even less than that, slightly less than that. So the risk of dilution for me is same across all commodities, regardless of whether you're an oil producing company, gas producing company, or a uranium developer. Because obviously, with a producer, if the commodity prices were to come down, you could be declaring bankruptcy a lot sooner than a developer sipping on cash. And ultimately, you're reliant on the commodity prices going up. It's as simple as that in a commodities bull market. So if what I'm trying to say is if you're eating away, if you're an oil producer, and let's say your cost of production is $70 per barrel of oil, and let's say your oil price goes to $50 per barrel, then you're losing $20 per barrel. And so you're draining cash at a much faster rate than you would as a developer just sitting on a piece of land, not spending any money. So I think ultimately we are all dependent on the commodity prices. And for us to avoid risk of dilution, the commodity prices, regardless of which commodity you're in or which company you're in, the commodity prices must go up for it to work out for us. So at the end of the day, for me, the biggest risk reward measure that I put in place is really what is the risk of downside? And obviously, when you're talking about the developers, it's a little bit different because obviously you've got the volatility factor. But for me, it's what's the downside of the commodity and what's the potential upside? And as you know, we use charts all the time, Andy. And when I look at uranium against any other commodity out there, it's by far the cheapest with a slight rounding bottom. If you put uranium as the nominator and anything else as the denominator, you're always seeing uranium pick up a little bit against everything else out there. So for me, it's the lowest risk from the perspective of price of the commodity itself, which means I think ultimately it's probably the best place to be in terms of the stock. So, and I understand what you say when you talk about the cash flows. I definitely understand that aspect. But for me, I've seen plenty of oil producers go bankrupt during the last decade. You've had commodity prices go down, oil producers go bankrupt. And they do dilute very heavily too when the commodity prices are not supporting their operations. So ultimately, it's down to the commodity price for me, and that's why I like uranium, because I think it's got the best risk to reward in terms of the commodity price, and you're going to get that extra leverage. And so when I pick my uranium producers too, uranium stocks too, I always look for a company with very high cash position that can kind of sustain itself without diluting the shareholders for the next 2 years. So that's kind of my criteria. So if I don't see enough cash balance in their books, I probably won't be buying. The only exception to that rule is when I see incredible valuation and I think uranium's gonna take off. And a primary example of that, the only company that I've got with low cash position is probably the most recent entry, which is a Capi Resources. They've only got like 2 to 3 million in cash. I know that there's an additional risk there, but I decided to take the risk anyway. But that's my only position with low cash, and everything else has high enough cash that they can sustain themselves for the next 2 to 3 years without raising new capital. So that's my approach.
Okay, and then when you say like risk reward, and you're
Yes.
talking about your uranium companies, you're mainly focusing on the commodity itself, right? Not individual specific companies. And you're just kind of taking and looking at the cash balances that they have, that they can basically float themselves out a certain amount of time. Did I state that correctly?
So the risk. So no, not really. So risk, there are a couple of other individual companies risk, right? So obviously you've got the management, you've got the piece of land that they're sitting on, you've got permitting and licensing potentially, you've got the jurisdictional risk, geopolitical risk. So I take all of that into account when I before I buy into a company. In terms of the potential reward, obviously I look at the previous valuation. So if I'm looking at companies in Namibia, for example, I look at the last cycle to see how high they've gone during the last cycle, to kind of try and figure out how high they could go this cycle. So obviously you've got the risk in terms of the commodity prices, but then obviously you've got individual company risk. So I look at all of those things before I put my money in.
And then I've got the yeah, what's up?
Hi, I think I'm late. I'm sorry. I'm lost in the
okay.
time zones.
Yeah, I know. We're all on different time zones, which is very difficult to set up. So right now we're talking about the risk in uranium, the risk in whatever sectors that you're invested in. We did talk about which sectors we like the best, the companies, how we're kind of playing it, developer, producer, exploration company. What's our allocation, portfolio allocation approach? These guys, Kasper and Scott, are huge uranium bulls. I am too. But they've allocated more of their capital to uranium than I have. I'm chasing cash flows, I guess, in relationship to maybe more of their stuff. So I'm heavily in oil and natural gas. That makes up a greater percentage of my portfolio than uranium does. And I think we're talking about the risks here. And the risks, I think we view risks differently, perhaps. They view the risk in the commodity itself. I also agree with that risk. But I also look at the companies, and I think our viewpoints are a little bit different on the companies and how we look at it. I'm chasing cash flows. I know we've got infrastructure in place with oil and natural gas. There's arbitrage play between Europe and Asia versus Henry Hub. And these companies, they had massive amounts of debt in the beginning. They've been paying their debts down. I think that with the cash flows that are potential out there, they could be earning in cash flow as much as their market caps in less than a year or two. That's what I'm looking at. And I don't see it in uranium. I view that as a higher risk. It's very speculative. What's your take on it, Fabi, in terms of what sector you like, in terms of the risks and your portfolio allocations?
Well, yeah, so I'm fully invested in uranium, but I am starting to change not the thesis itself, especially of the commodity. The thesis is the same, and it has immensely amplified since I started buying uranium stocks way back when. So everything looks better from a numerical perspective, except for, I believe, now the companies in the middle, right? So we have, let's say, Cameco and Kazatomprom as producers, and obviously as producers, they're going to get a bid, right? You're going to have generalist hedge funds coming in, all sorts of funds coming in. They're going to look at only the top two guys because higher market cap, better liquidity, actually producing, et cetera, et cetera. That end of the market, I think, will be, an easy ride, so to speak, compared to the rest. But what I do find is that with every uranium retail investor that I speak with, we kind of all have the same strategy, which is we all want to pick the next Paladin, right? We all want the stock that went from, 10 cents to 1 cent to $10, obviously. Except for the fact that when Paladin hit 1 cent, I believe its market cap was something around, $1 million. And we're all investing in hopefully soon to be producing companies, so late stage development companies. And we're looking at, their projects, the costs that they're going to have in 2022, the NPVs being based mostly on older numbers that have no reflection, in today's economy and today's costs. And you're looking at their market cap, and to me, I don't see a massive amount of value in the late stage developers, right? I like them. I still hold, quite a bit of that. But when I look at, the really big win, I see that at the top, with producers, and at the very bottom. So really tiny companies, excuse me, I need to drink some water. The really tiny companies that nobody yet knows about, that maybe have projects where, they're in the middle of Africa. I'm biased because now, I'm consulting with a company that has, some really interesting projects in Niger. Or, for example, the other side of me that's also biased, companies in the US that have proven pounds in the ground, but it's not compliant because this is from mines way back in the 60s and 70s that were operating in Wyoming, in Utah, in Colorado, et cetera. And so there are lots of these little stories that might actually be really good takeout targets for the producers, soon-to-be producers in the US. But I look at Encore, which is a company I talk about all the time, right? Because I made more than a 20 bagger in that. And I'm like, okay, looking at Encore's NPV, and if we were to be completely honest and try to update it to today's numbers, And the fact that we're still using 5% and 8% NPV in a highly inflationary environment is like kind of crazy, right? Because this is mining. It should be at like 20 at this point. But that's where I'm struggling to see massive value. And I'm always looking for like the cheapest thing that I could get, right? I love the sales. Like I don't buy stuff at full price. I just don't. So I'm looking at that, and I'm still, moving a bit of money towards the smaller plays, the little tiny companies that are sub 5 million, sub 10 million that nobody knows about, that have less of a geological risk because they're brownfields, right? And so yeah, I mean, I don't know what you guys are holding right now, if it's mostly developers, if it's a bit of exploration, or if you hold producers at all, but I'm struggling to see like where the big value is going to come out. And one thing that I've mentioned a few times is, I need the water anymore. And one thing I've mentioned a few times is Goviax coming out with their feasibility study, and the CapEx being just absolutely like eye-watering, really high for a country where things should be generally cheap in price. And I think that is a decent picture of where we are right now. So number one, prices absolutely need to go up. But also I think most people who are buying developers today are operating under assumption of numbers that don't exist in the current reality. So that's my my happy bucket of cold water.
Are you 100% allocated to uranium, or do you
Yes.
have other investments too? So you have 100% of your portfolios in uranium?
In my stock portfolio, I didn't mean it to be this way, but it just so happened. And I mean, especially now, because I've crossed over to the dark side of, being a director in a company that's soon to go public. It makes sense for me to liquidate and then put that towards buying cheaper stock in those companies, rather than just trying to risk it. So yeah, 100%. Didn't mean it to be that way.
Am I the only person that holds substantial amounts in natural gas and oil on this panel right now?
But maybe you should convince us, because I would really like to get into some of that. But I just think that the time it takes for us to even keep up with uranium, I try to imagine doubling that with oil, and I'm like, I wouldn't be able to sleep. And I like sleep. Right. So it's tough. But and also coal. I mean, coal is something that to me is really attractive, because everybody still hates it, even though the price of coal has been generating some very interesting cash flows for those companies. I don't know if it's sustainable, but I don't see coal just coming out of the grid all of a sudden, because we found a magic source of energy and we're not going to need it. I think that's highly unlikely.
Yeah, we actually in Denmark is starting to burn coal today, actually, from one of our power plants.
Wow.
Because I think I don't know the exact reason, but they started today burning coal in what at least the politicians would like to have to be Denmark the most green country in the world. But here we are burning coal, so it's it's a strange
it's reality,
time.
right?
Yeah, exactly. And also coal was actually I don't know if it was the best or top 3 or something like that investment in 2021. So if you bought coal stocks, in 2020, you could have earned many. The amount of money you could have made in 21 was just absolutely insane, because some of the companies you could buy, and then 1 year later they would have generated the same amount of money you've put in. So 1 year payback time. Wow. It's just, you don't find that anywhere, right?
And that's in dividends?
I don't know in dividends, but what their cash flow was compared to the value of the company. So yeah.
Nice.
He's talking cash flows now, like me. I chase cash flows.
Yeah, but actually, if you bought, in 2020, the cash flow the dividends you will get from some of the coal companies is like 50%. I mean, that's just amazing. Dividends 2 years later, you have all your money back. And from that, you can just risk-free capital. It's just, yeah, it's insane. It really is.
You're describing oil and natural gas companies that are actually going to make more money than these coal companies did in the next 2 years. They
Okay,
went from
Andy, so what's the pitch? How do we get in on oil without like sacrificing our work and family and everything?
Yeah. Well, yeah. Well,
what's your approach? What's your approach to figuring out like which companies to invest in oil?
I like the high cost producers. I like the ones up in Canada because they have exporting capacity. And if they're higher cost producers and we've had this nice big pullback, they've had massive pullbacks in their stock prices. If you look out and you were to project $100 oil plus, these cash flows just blow up. And they're going to make, some of these companies, even these smaller companies, they're going to make billions of dollars in cash flow, and their market caps are in the hundreds of millions coming out if you get the price, the oil price environment that I think is coming up in the future. So when I bought SM Energy, I'll just give you an example. I bought it at 167 million market cap. I think last quarter they made something like, I don't know, 300 or 400 million or whatever it was. I'd have to look. Just ridiculous amounts last quarter. That's gonna be $1 billion plus cash flow. Cash flow, not this is their income. They're gonna be over $1 billion income probably next year as their hedges roll off and as the prices remain relatively, I think, competitive, and their infrastructure is all in place, their debts are being paid down. So we've got something out there where the infrastructure is in place, it's generating cash, their hedges are all rolling off a lot of these companies. A lot of these companies are going to be unhedged for next year, and their cash flows are going to be ridiculous. And if we come into the SPRs, SPR releases coming off, we've got Russia production going down, and the entire spare capacity being eaten up, and demand from China coming back, we could get into a scenario where we moonshot in oil, where the people who think, like that uranium's going to moonshot, that could happen to oil. And I'm talking multi-hundred dollar barrel oil, because we've never been in a scenario where we've eaten up through our capacity. If you look at inventories back in the mid 2000s, that was just a large, we'll call it a credit expansion phase, with inventories still increasing in oil. Our capacity was all intact. We had multiple millions of barrels of capacity in the system. Right now, we're going to like zero and negative, which means we are going to be at the pumping capacity of the entire world that we've never seen before, at the same time that we have a natural gas crisis in Europe in the winter, and they're going to be switching to burn more oil. So we've got all this demand that I don't think's baked into the cake here, and we've got supply problems with Russia, because remember, the Western countries came in and are pumping it and keeping those volume levels high. We left. We've got sanctioned against them, and their supply or production is going to collapse. I think they're going to lose a couple million barrels of a day. So if you add this all up, you get 1 million, 1.5 million barrels coming away from SPR. You get 1 million, 2 million barrels losing from Russia. OPEC's tapped out till 2027. Oil shale, the growths have really slowed down. I think they're basically tapped out or pretty close. Where's this extra couple million barrels going to come from if China comes back online? We're going to be destroying demand. And if they're struggling in Europe with natural gas, they're going to say, burn whatever you can. I don't care. Buy oil, buy whatever you can get your hands on. Now that's extra demand that's not baked into that cake either. That could be 1 million, 2 million barrels. Now we're at a deficit of some couple million on the pumping capacity, and we're at the lowest inventory levels that we've ever seen in history in relationship to production, demand and production. So I'm looking at this like foaming at the mouth, because these guys already have infrastructure in place. They've got they're priced, they're priced 2 or 3 times their current cash flow. They're only priced there when historically they're at 5 or 6x. So they're half the cost of where they're supposed to be. Now, if the price of oil goes to 160, 150, 160, 200, which I think is a high likelihood. I know that sounds a little bit aggressive, but I think 120 is in the bag coming up next year. and I'm looking above that 160, wherever it ends up being, and you're buying at half the cash flow, and their hedges are rolling off, I'm going like, are you kidding me? Just hand me the money, I guess. And then, and I understand your guys, like you're looking at the reward in uranium and the potential boom, but like this is happening. Like I don't see, I've got visibility into the inventory. I don't have visibility in the inventory of uranium. So, and I'm a uranium bull, guys. I'm not like anti-uranium. I'm just giving you another viewpoint of another sector that looks pretty good. And natural gas is another one. Henry Hub at like $5.50 or $6 a million cubic foot. And you've got $30-$40 over in Europe and Asia. The only thing preventing us from shipping it across is Freeport, which came off and is 20% of the LNG shipping capacity in the United States. So what do you think the likelihood, when that was all linked up, it was $9. It came off, and it was going up and breaking out. The LNG terminal basically came offline due to a unknown explosion. It came offline, which is 20% of our shipping capacity in America. And now the prices have pulled back to $5, upper fives, low sixes. And when that comes back online at the end of this year, what do you think Henry Hub natural gas prices are going to do? And we're low in inventory. We had a hurricane come through. We're low in inventory from the heat this summer. I'm like, guys, we can see the inventory. It's there. Once that comes back online, it's boom fest again. And these things are, a lot of the companies that I'm in are as leveraged, or I would say as leveraged as a lot of the uranium companies. So I think the upside's there. I think it's all intact. And I think that the probability of this happening is pretty high. Just like uranium, though. I'm not a uranium bear, guys. Don't get me wrong. I have a good chunk of my money
People are
in
gonna
uranium.
burn you at the stake if you're not 100% in
Well,
uranium.
We've got all the.
Nope,
You
but
guys
that's a
are all
good pitch.
massive uranium bulls, and I'm just like the Han Solo guy staring at oil. Just like I think it's going to be just like coal, where the cash flows are just going to be so ridiculous that money's going to come piling into it.
Mm-hmm.
That's my viewpoint.
Can I add a quick note to that, Andy? I think the common theme is low inventory, right? I think we have low inventory in energy. We have it in metals. We have gold, silver, aluminum, steel, coal, whatever. I think that's the common theme right now. Is we're basically out of everything that we need to do in order to produce more or less anything, right? So I think that's also why many people are talking about this commodity boom, and I absolutely agree, because if you look at the COMEX inventories for gold and silver, platinum, palladium, and what have you, I mean, we haven't seen these low numbers in like a very, very long time. So that's the common theme, I think. Low inventory.
And I do want to comment on that. And the way that I think about it, as weird as this is, when I see low copper inventories, you know what comes to my mind? Not copper investments, but energy. Because how are they going to get it out of the ground? Oh, we need to produce more copper. And then the price of copper keeps continuing to go up. Same with their cost curves, as you've seen, Fabi, with a lot of these developers, their costs are all increasing. So everything's going to end up, I think, over at oil and diesel and gasoline and oil. And maybe there's the crack spreads of refining, depending on how much oil we can produce and the tightness in refining. But the buck will all transfer to energy. The companies may or may not make it in these, the mining companies, because what they're going to do is they're going to say, I want to mine. And then this tin producer wants to mine, the copper producer wants to mine, and the zinc or these diversified, miners, they all want to increase production because the price is going up. But then they look at it and they say, well, where's this energy we're going to get? We're in an energy crisis. Oh, we all want to buy oil. That's all future oil demand, right? So
That's a good point. I hadn't thought about that. Yeah.
Yeah, it's all oil.
Takes oil.
So I'm like pinning. I'm like, all industries are all searching for oil, and I'm like, oh, perfect. I'm just sitting in it with a 50% discount to free cash flow of today at $80 a barrel, where I think the future amount is going to 160, 200, 300, 400. I don't even know where it will end up, depending on how fast we can bring it online. And then you've got exporting capacities collapsing as well, as these countries like Russia, they're not going to export as much if their internal, if their oil sales go up, their internal demand goes up. So then the exportable capacity just collapses. So you're kind of left with, where's the exportable capacity in the world? And I kind of think it's up in a certain country, Canada. And I think that's kind of the last spot to be exportable, where they have increasing export capacity, I should say, not declining export capacity. Because Saudi Arabia, their internal consumption of oil is growing quite rapidly, over the past decade. So their exportable capacity, their exportable amounts just are continuing to dwindle down. So at some point, we're going to get real tight in oil, especially those that are looking to import. But that's my oil and natural gas case. I know that's I'm a huge bull there. I've never been more bullish in oil and natural gas since I've looked at these markets. I'm far more bullish today than I ever was in the mini boom of the 2000s.
Yeah. Also,
Nice.
if you look up at a chart for oil, it's insanely bullish. If you look up a chart for like 40 years for oil, it's very, very bullish. I totally agree.
So here's another question for everybody. We can start with Scott. So he hasn't spoke much here recently. How about over the past 2 years, has things developed the way that you thought they would? And looking forward, how do you think it's going to develop? So, we've started the commodity bull market 2020, somewhere in that time frame. Has this commodity bull market developed the way that you thought it would? And looking forward, what are your expectations?
I think it largely has. So when I first met you, Andy, we were talking about the mining cycle and how, the commodities have been decimated over the last decade or so, which really reduced the production of all the commodities all the commodities across the board. So yeah, I think we're definitely seeing the shortages play up now, and obviously we're seeing the commodity prices go up, and we are really short energy because we're peaking in oil production, we're peaking in all these energy production, and it's just been exacerbated by the Russia-Ukraine conflict. And I think that's a huge factor that just puts it's like a steroid, right, to the energy crisis or energy investment thesis, because they are such a large part of the oil, the energy game, right? Once again, like one of the biggest producers of oil and natural gas around in the world. So when you take that offline and basically go, you can't produce anymore and you can't export anymore because no one can pay you, then you're basically really putting the problem, or making the problem much worse. So I think it's going to be far greater of a commodity cycle than I had anticipated at the beginning of the cycle. And I think it's going to be, and you've talked about Russia, for example. You're 100% right. I'm a massive energy bull, right? Don't get me wrong. So it's not like I'm bearish oil or bearish natural gas or anything like that. I think they will do insane things. But yeah, like you've talked about, things that are going in Russia, for example, with the oil producers and them taking away, because they can't transact. Well, certain companies that offer drilling machineries, for example, to Russia, can't operate in the region. Now they're taking all those things away, and you're really destroying future production of Russian oil, even if the conflict was to resolve itself. So I think we're in for a much bigger energy crisis, and we're seeing it being reflected in how the governments are acting or reacting to all of this, right? So in the UK, for example, they're subsidizing electricity costs. In China, in Japan, in Korea, they are like massively scared, and they are running towards nuclear power, like never before. China's trying to build 10 nuclear reactors a year now. And that's why they're running off to Kazakhstan and Kazatomprom to try and source all that. I think Korea and Japan will probably do something similar very soon. And Japan typically likes to stockpile for a lot longer period into the future than your Western counterparts. So I think there will be, there will be a lot of fight to stockpile a lot of the commodities, because that is one way in which you can manage this risk. And it's like toilet paper, right? So when we're running out of toilet paper during the medical event, everyone was stockpiling toilet paper. Well, I think everyone's going to do the same with all the energy across the board. So, people are going to be stockpiling oil, natural gas, and uranium. And it's going to be a mad rush, which creates even more of an inflationary pressure in these commodities. So I think it's played out until the Russia-Ukraine conflict. I think it was playing out just as I had thought. And now it's like commodity super cycle on steroids. That's what I think.
Mm-hmm. What about you, Fabi?
So in the last 2 years, I did not let me re-say that 2 years ago, I never expected so much fundamental reasons to be bullish uranium, and to be bullish commodities in general and energy. I did not imagine that the supply destruction would be to this extent, that the logistics would be so messy for us to be in a situation where we are now. And to me, the sort of expectation for a big spike in uranium has kind of like stretched itself, right? Because we saw not just short-term demand for uranium, but also really long-term, China coming out, within the last 2 years and saying that they were going to double capacity. Now the US coming out and saying that they want to double capacity, which is also a big deal. And so to me, what has changed in the last 2 years is I thought that we would just hold our breath for a really big spike. And now it's like, it's probably a sit and wait situation for like a decade, because I don't see demand waning off for the better part of 10 years conservatively, maybe longer. Like we might be here with our like grandkids and stuff. I don't even have kids, so maybe you guys with our grandkids, saying that these were the good old days of finding cheap uranium everywhere, because like there's so much demand coming, so much. I did not expect the demand to increase to such extent. I'm positively surprised for sure.
What about you, Kasper? What's your take on it?
Yeah, whatever Fabi said. I mean, I totally agree. It's especially with Sprott coming into the sector and taking up like what is it, 40 million pounds per year or so they have bought. Plus we have this underfeeding also going right now, so that's 20 million pounds also off the market. So only from these two you're talking like 60 million pounds not coming into the market, year over year over year. And you have China making like, what is it, 150 reactors. That's roughly the same amount of uranium as well. So these two alone, or these three alone, is over 100 million pounds, not getting into the market or extra demand. So I think I was bullish in 2020, but the fundamentals right now is just getting better and better. And that's also why I keep posting about uranium on Twitter and so on, because it's just an amazing story. Hopefully it will be an amazing story for the grandkids, as Fabi says. It's I like it a lot.
We all have enough kids, at least Scott, Kasper, and myself, to have a little herd.
To make a soccer team.
Yeah, I know.
We should really do that.
I know.
For sure. When the uranium bull's over, we should film them playing soccer together and post it up.
Yeah, we should do that. That's a deal for sure.
Yeah, when I was looking at, I'll just give you my opinion here real quick. In 2020, I saw them like forcefully shut down because of the medical event. And that's where I got like ultra bullish on oil, because whenever you screw something up like that, we were also in an expansionary phase of real estate, which is a credit growth, credit supply growth, which is inflationary. We've got the millennials coming to home buying years for America. We have no inherent weakness in the market. They just shut it down. So I was like, oh, this demand's coming back. It's going to come back quick. And if you look back at some of my older videos, I was talking about $200, $250 oil in 2020. And people were like, Kathy Wood says it's never going over $20 a barrel. Why do you think it's going to go to 200 or 250? I'm like, guys, the disruption they created in oil is going to be felt 2 years from now. And that's where we are today. We're 2 years away from that.
Andy, were you saying that when oil went negative? Because
Yes.
that was a sight to behold.
That is where I got
bold.
ultra bullish. Yeah, it's bold
Nice.
because whenever you go to the downside, the farther you go to the downside, the farther you're going to go to the upside.
It's an
Because
elastic band. Yeah.
it swings the supply in a negative way because people are going to they're going to go bankrupt. They're going to cut back on production. They're going to cut back on energy service. They cut back on everything. And then what happens is they shut the economy down. And I'm like, this demand's going to come back. We're in the middle of an expansionary phase with a demographic and in the middle of an S curve of India and China. And I'm like, this is crazy. Like, this is going to blow up to the upside. And we got the ESG underinvestment. We've got all this other stuff. Oil's bad. Almost as if they were trying to do this on purpose. It was like, this is crazy. So that's what I see kind of going forward is this huge squeeze. And then uranium, I think uranium is going to do absolutely ridiculous things. The price of uranium is going to do ridiculous things. And I don't think people are fathoming it yet, because what they're going to find out, and what I think most companies are going to find out looking forward is, you know what? Energy is probably the most important thing to my business. Energy and the commodities that I run through it. And when they're not there, I think some businesses are going to struggle. So I think that we're going to be in a recession. It could be in a slow growth or recessionary kind of flat environment, maybe even recessionary, because you can't build a product if you've got one shortage. So, and we've got these highly complex, designs, components, all this stuff. And all you have to be is one component short and your product can't sell. And I think that's going to bite people in the butt. I think we're going to slow down production of anything that's in Europe with energy shortages. And I think that's going to be recessionary. It's going to be a big slowdown. So I think the constraint is energy. And that's where I think you have to be looking forward. I think if you're not in energy again, guys, this isn't advice. It's just my opinion. If you're in precious metals too, I think currencies are going to have problems. So when you look at energy and it starts to kind of buckle, where it collapses and it comes back, you have to pull all your GDP back, and that GDP with a bunch of debt, GDP pulling back with a bunch of debt that has to increase by the design of the system, you're going to see 10-year yields, gilts, go through the floor to the downside. Then you're going to say, okay, what's the human response to this? The human response is, I need to protect my wealth. What do? What do? You're going to run to something. Some people will run to precious metals. Some people will run to commodities. Some will go buy physical things, whatever it is. And I think that's going to be the play for the next couple of years, I think, going forward. It's going to be real things, and it's going to be a protection of one's wealth, and energy is kind of the root cause of all of it. That's my take on it. Agree, disagree?
Yes, I think it's,
go ahead,
sorry, just
Fabi.
really quickly, it's really important that you mentioned gold and currencies. I mean, gold as a bet against currencies, because like gold has sort of, I guess, traded in a slightly contracted zone, I guess you could say, for lack of a better term, that it goes nowhere, and it hasn't really gone anywhere for a long time. Thankfully, because it's not, like massively breaking down. But you look at the gold miners and it's just absolute carnage. It's very difficult for me to remain 100% in uranium until the end of the year, because we're coming up to North American tax loss season. And the some stocks in the gold sector are like 50% down what they were in 2020. Like, the price destruction has been just something to behold. And a lot of these companies are making, decent money, especially compared to previous cycles. And so it's just interesting to see, and definitely something that I'm watching, because I'm just going to have to buy gold miners at some point between now and Christmas. And there's no like tax loss rule in Portugal, and so I can just like buy, sell, and book the losses. And so for me, I can come back very quickly, and I will be using that to its full extent for sure.
Kasper, are you gonna say something? You're on mute, just let you know.
Thank you. I would have been talking for ages then. Can I show a chart real quick,
Yeah,
just to
it's
show you
open
the
to
relation
share.
between energy and gold and silver? I've showed this once before, so you might have seen it, but yeah, I think you can see it, right? I guess.
Yeah, it's the ratio of URA to UX1. Yep.
Yeah, exactly. So this, as you talked about, precious metals, currency, and energy, they are so much related together, probably more that we even think of. Same goes for back in 2008, right? We had this oil prices going to like 140, and that's also when you saw gold and silver really accelerate from that point on, and 3 years ahead. So I think everything is connected, but energy is the overall driver of everything, as we have talked about. It's you need energy for everything you do in life and so on. And the higher the energy cost, often you see gold and silver accelerate as well. So as I mentioned before, if you are a uranium bull, you should be a gold and silver bull as well, because they are so well related to each other. So when energy goes, silver and gold goes as well, because that is inflation. So yeah, just a quick side note. But yeah,
I like it. So what else does anyone have to share? Those are all kind of the questions that I had prepared already. What else or comments do people have?
Just an idea that I think would be worth exploring as financial advice for people in general would be to take a look at your portfolio maybe, every month or every 3 months. And I'm gonna try to start doing this with my husband because he doesn't really care about investing. Obviously, he cares, when we lose big and when we win big, but he's not interested in the exercise of finding good investment opportunities. But I think one good practice that I would recommend to anybody is to start looking at your portfolio and trying to defend your portfolio and go down, stock by stock and say, okay, this is the stock I'm holding because of reason XYZ. And you'll find that for some of those, you no longer want to allocate any more money to them. That is usually a flag towards you not truly believing in it, or you not really believing that it's super cheap or it doesn't fit your thesis anymore. Or maybe you're just holding on, you're like your heart's kind of out of it already, but you don't want to lose that much money, and so you're waiting for the price to pick up. I would advise against that. I would advise, again, towards looking at everything that you hold, and if you can't defend it, then seriously consider putting it on the chopping block, because I've been hearing a lot of people say, I'm holding this and I don't want it anymore, but I don't want to lose the money. Well, guess what? You've lost the money already. And if you're not willing to buy more at these prices, then maybe there's something out there that's better for you. That's my parting thought.
Yep. I like it. Anything else with you, Scott? Closing comments? Let me guess.
I'm just like,
let me guess. Buy
Sorry, go.
uranium?
Yep.
I'm just kidding.
No, I'm just hugely excited for the upcoming, the commodity super cycle that we are in. I think this is going to be truly life-changing. And I would just encourage everyone to look into the data and just look at, when I tweet out saying, 300, 500, or even 4-digit uranium prices, people think it's crazy, but I don't think it is at all. Because simply just following, the SPX return from 2000s to now, they did 3x, right? So why shouldn't uranium spot price do 3x what it did in 2000s if the fundamentals are so much better? And that's just chasing the amount of money out there, empty money supply. So I was strongly, I mean, the biggest mistake, one of the biggest mistakes I think you can make in this commodity super cycle is selling out too early and selling yourself really short in terms of how much profit you're going to make. So I would strongly encourage you guys to just do your research. Look at the reasons why, you know, people like India are so mega bullish, or Fabi and Kasper are just so mega bullish on some of these commodities, because you've got all these underlying drivers. You've got so much more money in the system. Just look at simple things like, you know, S&P 500 or Dow Jones Industrial Average, or you know, the Nasdaq. Just in indices alone have done, a lot of them have done 3x the 2000s. So I would just strongly encourage you to just think everything and compare it to the amount of money that's available in the system. Yep, that's my closing comment.
What about you, Kasper? What do you got?
I think Scott said it perfectly. I mean, I think what we started to say during this interview is that, you know, sitting on your hands and do nothing is the most difficult thing to do. And I think that will be the case here again, because you will see, hopefully you will see your portfolio go up a lot. And as mentioned, it will be life-changing for many people. And at that point, you really need to have your cool and stick to your plan, because, you know, you can, you know, back in 2020, you know, a lot of the miners went 500% or 1000% within four months or so. And you will see the same again. I truly believe that. And that's when you need to have a plan and stick to it. And don't get scared. I know it sounds cheeky or whatever, but don't get scared when your portfolio gets to when your money on your portfolio gets to a big level that you're not used to. Because I will also get, you know, to a level in my portfolio where I will think, okay, this is actually a big chunk of money, right? So I have to keep my calm and follow the plan and the technical analysis that I do every day, and hopefully I can get a good exit at some point in the future, and then just be happy with what you have been doing. So sit on your hands is what you need to do.
And I'll give my my opinions here, which I think mirrors some of the other opinions. Have a strategy. If you don't have a strategy and you don't have a vision, you don't know where you're aiming. You have to aim at something. You have to go after it. This is in life in general. So if you want a job, you have to aim at that job. You have to go apply for it and put effort towards it. Same thing happens with stocks. Be excited when others are fearful. Be fearful when others are excited. So just do the opposite of everyone else. You know, it's not a good time to add in when you're chasing price. Chase value. So chase the value. Don't chase the price. And we're going to have times where we see gigantic moves higher, and then we see long consolidation periods. You consolidate longer than when you go up. So you get these impulse moves higher, and then you consolidate, especially in the beginning of the bull markets. They kind of just chop around a lot, and then we get gigantic move, and then it chops around a little bit, and then I think the chopping will decrease, and the move will accelerate as we get closer towards an end. So right now, I think we're in the beginning because we're chopping so much, and we're seeing a lot of volatility. So know that you're going to see this volatility. Know that it's going to be a little bit boring in the beginning, and then the big gains are all coming, I think, towards the end in blow off type fashions out in the future. I don't know when that exactly is. It could be 5 years, 6 years, 7 years. I don't know. It could be 3 years. But it's out there in the future. And I think what they get massively wrong as a new investor, what I did wrong or whatever, is you're trying to trade, you're trying to do things where you're trading, you're using the price as an indication of you being right or wrong, and then you get scared as that price goes against you. And that's kind of like the new investors' worries, is like, hey, this has gone down 40 or 50%. And I look at it like, well, that's kind of normal in a commodity, ultra volatile commodity. These things are going up and down 30, 40, 50, 60%, sometimes even more than that, especially in the beginning. It's a very tough ride for someone who's not used to the volatility. Volatility is not risk. And risk is, and I know I'm looking at it from a bankruptcy risk type scenario where you lose your money. It's just volatility. So you kind of have to get used to it. And if you want to make a lot of money, you have to train yourself to be good at handling these types of swings, because it's inevitable. You're not going to be able to avoid it if you're swinging for the fence with some of these companies that we're talking about. You're going to see 50%, 60% pullback. So just psychologically, emotionally, you're going to have to develop very quickly if you want to ride it through this bull market in commodities. So, that's some there. My take where I've made the most money is chasing cash flows. I haven't made as much chasing ideas or narratives. So I've made a lot more money. I've been a lot more successful chasing cash flows and chasing lower risk, high reward scenarios. And what does that mean? I've made a ton of money, of purchasing power gains, in swapping precious metals at certain ratios. There's very little risk there. Does it matter what the inflation is? Nope. Deflation doesn't matter. All that matters is the ratio and accumulating ounces. So there's that I play, and I play it with a large chunk of my money. There's no.
Sorry, can I just ask you, Andy, like what numbers you're looking for ratio? I'm assuming you're talking about gold to silver ratio.
Gold, silver, platinum, palladium, and there's not really good way to play rhodium. Rhodium would have been a huge one, but I've played palladium in the past. Right now, platinum's the cheapest metal of all of them by a long shot. And then you've got silver, which I also think is a good cheap metal, and it's also got monetary aspects. I think if you look at the ratios, it looks favorable for silver to outperform. I also think that platinum's going to outperform. So those are the two metals that are my favorite. Gold is also a good one if you want a monetary kind of anchor to your portfolio. So if you swap these metals, what it does is it takes away all the risk. So a lot of people, what they want to do is they want the 20 bagger, they want the 20x, they want the 30x, they want the 40x. They get obsessed with the potential return and the gains that that return and the materialistic stuff that they can buy with it, or the freedom or whatever they get with it. So they get obsessed with that. What they forget is that you can hit, doubles and triples in this game. You don't have to be swinging for the fence every time. So if you get a double, that equals a home run in terms of your runs batted in, or however you want to measure it. So what I've done is I've taken a gigantic sum of my net worth and said, I don't want to risk it. Where's a low risk, very high reward opportunity out in the markets, given the changing market conditions? I look at the three pillars: ratios, market conditions, and technical analysis. And when things are cheap, like precious metals, physical metals, and you're seeing stress in the system, well, why not double down on it? It's like picking up money off the floor. I'll just pick up money off the floor wherever I can see it. So it's like, hey, look, we've got gold, which hasn't accounted for the money supply. It's ultra cheap against stocks. It's ultra cheap against anything you want to measure it by. Then you look at platinum, and platinum's cheap to gold. So what does that mean about platinum? Platinum's cheap against everything, I think, outside of maybe uranium. And it's like, just pick it up, the physical metal, and there's no counterparty risk. What am I, risking here? I'm risking that the developers and the developers are not going to get their, just like you said, it's costing more to take it out of the ground. And then you've got producers which are having supply chain problems, an energy crisis. You think energy crisis isn't going to impact their cost curves? No, I think they're going to go up. So I'm looking at this going, well, the physical metal is probably the least risk, highest return in terms of risk reward, is probably one of the best because the risk is so low. So if I can get this, I'm just going to take it with some of my money. I'm going to say, just take it. Like, Andy, what am I doing? Just take it. and then I buy it and I take it. And then the other portion. So here's another thing that maybe is different from me versus others. And I know I'm making this a little bit long, but I compare everything to the return of gold. I view gold as it's kind of like my bond. Like, people look at the risk-free return of a treasury bond, but I look at it as a bond in a high debt environment, in a high inflationary environment, as ultra risky. So what people are going to do is they're going to change their mindset given the market conditions and say, well, I'm going to compare it to gold. What is my returns on gold? If I can't beat gold with taking on some sort of risk, if the risk of gold is essentially, we'll call it zero, and I can buy gold, and I can't beat gold with taking just a teeny bit more risk, then just buy gold. Why speculate, right? So whatever I'm speculating in, I have to destroy gold in my returns. So when I look at it, I look at the ratio, I say, this asset's cheap against gold, I think it's going to compress, and then I go to the leverage of the companies. Right now, I think oil, natural gas, uranium, those are like the best. Same with platinum, and physical silver. The ratios went to astronomically high ratios for platinum and silver. We're up over 100 in silver. If you can identify that and you know that your time frames are long enough, you hedge yourself with time, 2, 3, 4, 5, 6, 7, 8, 9, 10 years, you're going to make money. You're going to make purchasing power gains because that ratio will revert as the market conditions become realized by people. So all my portfolio, if you look at it in its entirety, is completely constructed based off of risk reward probabilities of happening, and the swing for the fence type stuff's all cash flow. I'm going after cash flow, and then I've got my really swing out to the fence with my uranium companies, and then I anchor it by the lowest risk stuff that I can purchase. So I know a lot of people, they get in there, they're brand new, they want to swing for the fence with 100% of their portfolio. And it's like, I just don't know how successful you'll be trying to swing out of your shoes and potentially, fall over as you swing. It's like, get the singles, get the doubles. The games are won by getting people on base and hitting them in. And sometimes if you're a really good, team, you can hit it out all the time. But usually you start off by hitting singles, getting walks, and doing that. So that's what I look at. That's what I do. I know Scott's over there kind of laughing. Agree, disagree?
No, I agree. I agree. I mean, a lot. I mean, my uranium is only about, as I said, less than 40% of my portfolio. So other portfolio is much more conservative type of investment. So, I agree with you. Like even with my precious metals holdings, for example, they are like all producers that are trading at like ridiculous valuations. Either through the lens of cash flow or earnings. So, I agree with you. I think you need to have the fundamentals well established, and then build the speculative plays on top of that. So I agree.
It's okay to disagree too. I'm fine with it.
No, I do agree. And a massive part of my portfolio is just precious metals, like physical precious metals. So, and that actually gave me a huge opportunity to like really build up on my uranium position during the last couple of months, because we've seen some really good prices, and I honestly didn't think I was going to get another opportunity like this, but I did. So I said, why not? Just like that's my cash. Let me get rid of it and buy some, cheap uranium stocks. That's how I play the game.
And yeah, another thing real quick, another thing that I did when I was looking at this is I locked in my costs as well. You buy a house, you can lock in at a fixed rate, 30-year fixed rate mortgage, get that down real low, because in an inflationary environment, your costs can move up on you. So that's another thing to look at.
I wish I would have locked mine at 30, but I couldn't because I bought it here in Portugal. So the maximum I could lock it in for was 10, and I did, and that was less than 2%. So win.
Perfect.
That's so
But here's something. Yeah, in Denmark we had, at the lowest, we had you can get a 30-year for 0%. 0.
Wow.
Yeah.
They were just giving away money.
Exactly, free money for you. Yeah. Most of them, many that I know have 0.1, maybe 1%, 30-year fixed. I mean, that's just free money, right? It's insane. So yeah.
I don't know if this is possible. It's just an idea. Can you actually could I get a loan from England or Denmark or somewhere in Europe, do a 30-year fixed on an American asset, and then have my dollars pay it back in their currency? That would be awesome.
If you could get credit in all of those countries, like, congrats.
I know.
That's the hard bit.
Okay.
Yeah, because when you
So-
land in a new country, and I should know because I lived in a few, but when you land in a new country, it doesn't matter like what you have in other countries. They're like, no, we want you to build a record here. So you kind of start from scratch as if you were like 18. It depends also which country you're going to. I'm assuming that like Canada to US would be like fairly transportable, but most other countries are like, we don't know who you are, convince us that you deserve a bank account kind of thing. So you start from the very bottom.
Yep. So does anyone else have any final comments or anything? Nothing else?
Except for buy uranium, buy energy,
Yes,
buy
I
gold
agree.
and silver.
Yeah.
I like all those. I agree. All right, guys. Well, that's all we've got. I appreciate everybody coming on today. Fabi, thanks for coming on. Scott and Kasper, really appreciate it. Guys, definitely check out their Twitter. You can find them all on Twitter. They're all on Twitter. Some of us have YouTube channels, like Scott has one. I don't think Kasper does. I don't think you have one either, Fabi, right? You
I
just have
do.
Twitter?
I was the
you
first
do?
one out of all of you to have a YouTube channel. I was there when there was
What?
like nothing on Uranium, but I haven't used it in a while. I am considering reactivating it. So if enough people are bugging me about it, I'll reactivate it soon. But if
So,
people can find me on Twitter, it's the next big rush. And then you can bug me there for reactivation of the old channel.
Perfect. Perfect. All right. Well, that's all I've got. If you've made it to the end, definitely put a comment in the comment section. The big four. The big four is all us. So the big four, put it in there. And we'll see everyone next time. Thank you.